Auto loan delinquency rates are at an all-time high, even higher than the peak of the financial crisis. So today we're going to get into some of the data, kind of see how we compare. We're going to look at auto loan delinquency rates, consumer credit card debt, total consumer debt. We're going to look at smaller banks, how they differ from the total banking sector, because if you're unaware, a lot of the smaller banks outside of the top 100 hold a lot of consumer debt as well as commercial real estate debt. So we're going to take a look at some of that today, see how it compares to 2008, because there are a lot of cracks in the economy right now. And yes, there are some people talking about it, but they're not really kind of saying how it can relate to other sectors of the economy as well. So first we're going to look at auto loan delinquency rates. This is past 60 days, so that means 60 days without a payment. And all of this data set comes in every single month, and it goes back to the year 1991. So as you can see, in the mid 1990s, we had another auto loan delinquency debt bubble, let's say, and that sort of led up to the dot-com bubble. Completely unrelated, dot-com bubble was in the tech stock sector, but this kind of sort of aligns with all of these enormous rises in bubble territory parts of the economy that we have. When people feel extremely confident, they start to buy cars they can't afford, houses they can't afford, take out a lot of debt because they think money is going to be free forever. And that happened leading up to the dot-com bubble, leading up to the financial crisis, and potentially, are we around the corner to another debt crisis? Well, looking at a lot of data, it kind of seems like it. So leading up to the dot-com bubble, we had 6% auto loan delinquency rates in the subprime sector, and also in the prime sector, that actually went up quite a lot. And then we had a collapse, of course, and then things were pretty normal leading up to the financial crisis here, where we had 5% auto loan delinquency rates in the subprime sector. Again, you had the prime sector go up, very negligible compared to the average, at least for the last 10 years prior to that. And that was around a little below 1%. But as you can see, in the subprime sector, it skyrocketed very quickly from 2% to 5%. And if you look at what is happening right now, leading up to the, let's say, the COVID crash that we had in 2020, the auto loan delinquency rates also were skyrocketing. In fact, we almost hit 6% leading up to the COVID crash. And COVID, obviously, we had a lot of free government money that was being printed, so people were making a lot more money than going into their minimum wage jobs, and that got paid off. Loan delinquency rates plummeted because of all the free money that was being given out, because interest rates were at record lows, and then it started again. So we had loan delinquency rates in the subprime sector. This looks like around 2.5%, so similar to what happened pre-financial crisis. And then this huge rise has been happening basically since 2021. And now we are at 6.6%, which is the highest since this index started tracking. And if you look at the prime sector, that has also been rising around the same period of time in 2020, but we're still only at 0.4%. Now do keep in mind that the financial crisis topped below 1% for auto loan delinquencies. So the subprime sector, I think, is the main area of concern, or at least a lot of people need to be paying attention to, in my opinion, because we had a subprime mortgage collapse in 2008. Now, obviously, subprime auto loan delinquencies is not going to at all cause another financial crisis, but this is more in line with the total debt that we are seeing consumers continue to build up, which is why, in my opinion, bringing this to real estate, if you're interested in buying a house, I think you need to be very cautious in areas where the top 10% do not live, in my opinion. I think areas where only the top 10% can buy are going to continue to be fine, but areas where you have lower down payment purchasers, FHA, VA, buyers, in my opinion, we could start to see some cracks showing in the real estate market, because those are the individuals that are not paying off their car loans, they're not paying off their credit cards, and now the student debt issue that is happening this month, all of this could sort of cause a lot of turbulence in the real estate sectors where people are buying with low down payments. So we're also going to take a look at the delinquency rate on consumer loans for all commercial banks. As of right now, 2.75%. We are now higher than the pre-pandemic numbers of around 2.5%. Taking a look at the financial crisis, we peaked around 4.8%, but leading up to it in 2007, it was at 2.9%. End of 2007, it went to 3.4%. And that is when the financial crisis essentially started. And we've gone from 1.5 to 2.75 in Q4 of 2024. So we'll have to monitor this and see how it progresses into 2025. But in my opinion, there are some cracks showing in the economy, and I think people need to start paying attention to this because there are potentially issues that won't be fixed in the near term, especially if interest rates remain at the levels they are right now. And in all honesty, they're probably not going to be coming down anytime soon. Potentially in the second half of 2025, we might start to see more interest rate cuts if these cracks start to appear a little more obviously in the economy, let's say. Now, if we take a look at delinquency rate on credit card loans with banks not among the top 100, which is what I was talking about earlier, we are at all-time highs. In 2023 and early 2024, it was 7.8%, and the financial crisis was 5.6%. And again, in the dot-com bubble, around 6%. So as I was mentioning earlier, the consumer who generally needs to take out a lot of credit card loans, needs to get high loan balances for their cars, needs to get high loan balances for their mortgages. Those are the consumers that are struggling right now. The ones who have their house paid off, the ones who bought 30, 40 years ago, the ones who don't have any credit card debt, no car payment. People in that bracket are doing fine. But the other consumers, they're tapped out. I mean, auto loan delinquency rates are at an all-time high. We just saw this. Credit card delinquency rates with banks not among the top 100 are at an all-time high. If we look at delinquency rates for all banks, we are rising, but we're not at an all-time high. We're sort of higher than the pre-pandemic era of 2.6%, and now we're sitting around 3% when you consider all banks. But the financial crisis, that went all the way up to 6.7%. And again, leading up to it, remember, the financial crisis started in 2007, but was not announced until 2008. 2007, we were at 4%. Right now, we're at 3%. We're not that far off from these delinquent levels. In 2021, we were at 1.5, and we've doubled since then. So perhaps in another 2 years, we could be seeing levels like 4.8, 5.5% yet again. Either way, we'll have to wait and see how everything plays out. As far as what's going on in the economy right now, we have the unemployment rate still remaining around 4.2%, which is good. Inflation numbers have been declining all year. We'll have to wait and see how that data comes in over the next 2 to 3 months. But I want people to understand that there are cracks in the economy. And in my opinion, if you're going to be buying a new car, buying a house, taking out another loan to go on holiday, go on trips, this is not the environment to be doing that. If you're going to be buying a house, I wouldn't be buying with less than 10% down. If you're going to be getting a car, I would see how long you could hold on to your current car. Maybe you lease something. The monthly payment is significantly less on a lease than taking out a loan to buy it, especially with interest rate levels that we have right now. Buying a house, if you're 20% down, I think you're fine. But understand, if you're 3.5% down and all of a sudden we have a 5 to 10% correction, you're going to be underwater on your mortgage. And very few lenders will be able to refinance you if interest rates eventually drop down over the next year, year and a half. So all of this, just to be cautious, this isn't a fear mongering. We're about to go into another 2008 era. I just think we are in an environment where consumers need to hold on to their money. I wouldn't be spending it on extravagant things, especially if you're in this environment where maybe you have a car loan, maybe you have a lot of credit card debt. I would just start to be a little more conservative with your money. That's just my opinion. Let me know your thoughts in the comments. If you're new here, my name's Ian Phillips. I'm a realtor in Southern California, but I love talking about the economy, data, what's going on in different markets, what's going on in the stock market. So I'm going to be uploading daily, if not weekly videos. So subscribe to the channel if you like this video, and I'll see you next time.